Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy. Hello, everybody. It is just about 10 o'clock on Tuesday, so we're getting started with our webinar. Excuse me, a little bit of coffee before we get going. Tuesdays are good days because I always say it's going to be a beautiful day here in Bucks County, Pennsylvania. So if you're with us here in Bucks County, I hope you get outside. If you're in other parts of the country, I hope it's great where you are too. I know there's several of you who come in and join us every week from Arizona and the Carolinas and Florida. So we appreciate that. And we like this time of year up here in the Bucks County, Pennsylvania, New Jersey area, because, you know, we don't have to hear your post or read your posts or hear your comments about how warm it is where you are. And we're nice and cold, but not today. So this week's supposed to get up in the 90s. So it's going to be a great week for getting outside. I'm starting my training for my trip in September. So we'll be back in Kentucky this September, my biking group and I, and we'll do, I don't know, I don't remember if it was 250 miles or close to 300 miles a few years ago when we rode through Kentucky. We spend about three days there riding our bikes. We'll be there a little bit longer. So I'm really anxious to get into some really good training for that. So good seeing everybody. And we'll go ahead and get started. So today's April 27th. Happy Tuesday. I want to remind everybody that you are muted. There is Q&A at the bottom of your screen. Your chat is disabled. And as always, these meetings are recorded, or these webinars are recorded. So we've really progressed well with our webinar recording. So we've done the intro and outro for really all of our 2021 webinars, and we're starting to work on our 2020 webinars, including our classes. So now the process that we're doing is uploading them onto the webpage the correct way, and then they all had to be reviewed by our compliance team to make sure that I'm not saying anything I shouldn't be saying, but you know, I'm pretty careful about it. So and that means, you know, not referring to any one company or guaranteeing returns or certain silly things like that. So often you'll hear me say when I make a when I talk about an individual company or an individual fund as an example, I'll say exactly that. It's not a recommendation, but it's an example. So we do have some webinars that we're working on scheduling that are coming up. These special webinars that are held on Wednesday evenings at 6:30, in addition to the Tuesday webinars. So that is, you asked for this, for funding, using annuities and retirement planning and Roth conversions, fiduciary assistance for powers of attorney trustees and executors. This has become suddenly very popular. I'm getting a lot of requests about this from attorneys and clients. So kind of interesting how these things work out. You know, one item pops up and then it starts kind of a chain effect. So, and then investment fundamentals is another one that we'll do. And we may have to do that over a couple of nights because there's a lot to cover there. But I'm working through those topics and we'll schedule those soon. We're going to, as always on these webinars, we go through a market update. So I'll give you some market update, and I curate some analyst reports that I read throughout the week and share those with you. And then I talk about a financial planning topic. And today's financial planning topics is going to be planning for taxes. Now, you hear me talk a lot about, and you certainly experienced this over the years if you're clients of ours, my concern about rising taxes in the future. And you know that I believe that taxes have to double over the next 10 years for the average middle-class American. And the average middle-class American, from what my studies show, will be paying an effective rate of somewhere between 40 to 45%, in my opinion. So, but the new conversation right now, what's happening right now is there's a lot of discussion around capital gains. So we're going to talk about what capital gains really are, what the proposed changes are, and what the current rules are. So that should be helpful. And so let's get started on our update. So there wasn't much from Ed Slott this week. Tomorrow, or excuse me, Thursday and Friday, I'll be in my Ed Slott seminar. I fly somewhere and attend these 2-day events twice a year with tax law updates and IRA distribution rules and effective strategies. And I think it's just wonderful. As you know, there's only 400 of us in the entire country who do this, and I don't understand why that is. Every morning I read through the Financial Planning Association. So these are all CFP, some attorneys, CPAs, and they ask questions of the group, right? It's a chat board. They don't call them that anymore. I forget what it's called now, but they ask questions of the group, and one of them today was trusts as beneficiaries. And I just think if these folks were part of the Slack group, they would have those answers. They would probably know a lot more off the top of your head, or just being able to research it. But you would certainly have a great team to refer to really get good answers, and not just different opinions from hundreds of different people. So anyway, I can't say enough about the Slack group and how beneficial they are, but not much from them this week. My point was I'll be attending my spring training this week via webinar. So Thursday afternoon and all day Friday, I'll be on webinar. But if you need something, of course, you can contact the staff. This week, they talked about solo 401ks. So solo 401ks are when you're a sole employer and you can just have your spouse in there as well. So the IRS had said, they announced that they're targeting several employer plans for stepped up auditing in solo 401ks. So I'm not going to get into the details, but if you have a solo 401k and you have any questions about that, feel free to reach out to us and we can plug you in with an appropriate person, or maybe answer the questions ourselves, who can help you. As a follow-on to that, you know that when you log out of this webinar today, you'll have my calendar should populate and you'll have an opportunity to schedule time with me. I offer everybody a one-time, no cost, no obligation consultation to go over your questions that you have, your situation. And that we spend about 50 minutes. I'll give you an hour if I don't have anybody right behind you, but we spend about 50 minutes answering your questions, going over your situation. And if it makes sense, I'll do a before and after comparison, or map out some strategies for you on the whiteboard. So how did the markets do last week? Let's take a look at our wonderful Invesco reports that I just love. So last week, it's been a positive year so far. The year-to-date return is still very, very good. 11. I just need to make this a little larger for myself. And now I can't. Now I lost my spot. 11.86. So almost 12% for the year is the Dow Jones Industrial Average. So that's the overall broad-based market. Year over year, so from April 23rd of 2020 to April 23rd of 2021, still up 47%. That's outrageous. The S&P 500 over that same time is up 51.9%. But last week was negative, really across the board in the stock markets. 0.42%, so just under 0.5% for the Dow Jones Industrial Average, and just above 0.10% for the S&P. So slightly down, but still down overall. The bond markets, remember last week we talked about the risk of bonds, rising interest rates. Bond markets were up slightly last week, so that's some stabilization there. That's good. But that's where we all are with the market. So it's going to be choppy. It's going to continue to be choppy. We have this discussion coming from Washington now. This is the top of mind for everybody. Where are my taxes going to be? They're talking about estate taxes. They're talking about capital gains. They're talking about regular income taxes. There's a lot of discussion around it. And we don't know, of course, where that's going to land. And let's talk about what some of the analysts are saying. So BlackRock made it to our list today, and it's been a little while, but they're sticking with a powerful economic restart in the U.S. So they say a powerful economic restart is underway in the U.S., with Europe and the emerging markets set to follow. So they say there's, because of pent up need, um, and people wanting to get out there, and of course having some cash on the sidelines, that it's going to be a very good year in the 2021. Remember, the majority of people are saying, and BlackRock was one of them last week, that they're concerned about 2022, but 2021 should continue to be a good year. However, the market, it looks forward. So while 2021 might still be good, the discussion you'll hear is that may already be baked in to the market returns. So it could be that we may end the year where we are today, and that wouldn't be terrible, nearly 12% for the year. But we could also see some negative downturn for the rest of the year if it gets pretty clear that 22, 23, and maybe forward will be tough economically. And we'll talk about what could drive those factors down. But BlackRock is pessimistic. So they talk about a pro-risk stance, which means they're putting more money into the stock, or you'll hear equity markets. Riverfront also made it this week. So the key takeaways on their report was the U.S. has maintained its economic dominance over the past year. We think this will continue due to stimulus and vaccine availability, and we remain overweight U.S. stocks in our balanced portfolios. Excuse me. So you'll remember maybe that last year, BlackRock's a tactical organization, so they'll make bets against or for or against different areas, and they said they were underweighting the U.S. and overweighting the European Union and other global areas because they thought the response was going to be better in the EU than the U.S., and that worked against them. So that's one of the drawbacks of the tactical models. Riverfront took a different approach, and they remain overweight U.S. stocks in the balanced portfolios. Prudential had a lot of interesting views, but they're contrarian to what we just heard from BlackRock and what we just heard from Riverfront. So Prudential says non-U.S. stocks should outperform those of the U.S., consistent with faster growth of international companies relative to those in the U.S. So here we have three different analysts, two agreeing, one saying that's not how we see it. This person says the S&P 500 is a defensive equity index, equity is stock, because it is dominated by shares of predictable high growth and rapid growth technology companies. Conversely, stock indexes in Europe, Japan, and emerging markets are dominated by stocks in economically sensitive sectors. So what they're saying is that there are rapid growth technology companies that are overweighting, and we know this. We talked about it last year, the S&P 500 and Dow Jones, and certainly the NASDAQ. So we've seen a lot of growth in those companies. And we've experienced a lot already. So what Prudential's saying is we've lived that already. Now we think that these economically sensitive positions in the other parts of the world are going to excel as things start to come back and people start to re-engage on a higher level. And they back it up by saying during the periods of rapid world economic growth, as is expected this year and in 2022. Now, again, Prudential's saying not so fast. We think 2022 is going to be a better year as well. Earnings in cyclical stocks tend to outperform stable growth in defensive sectors. So I think it's really interesting when you get these differing opinions from different analysts, and that's why you can't just follow one. That's why that strategic asset allocation model makes the most sense to me, and has worked well for my clients over time. And we're not going to talk about strategic versus tactical in detail today, but I'll just give you a brief definition. So strategic asset allocation assumes that if you follow a certain asset allocation model and you're well invested in that, so you've got your pie chart set up well, and you have the components of that pie chart being the best that they can be, that over time, given a certain amount of risk, you're going to get a certain amount of return. That's a foundation of our investment strategy, but you folks all know that we go much further beyond that, because we not only use that strategic asset allocation, also principal protection and account segmentation. So those three stools really give us the stability that we need. Tactical allocation says we're going to do things like underweight the U.S., overweight the U.S. We're going to buy gold. We're going to underweight gold. We're going to, there's just so many different things that tactical investing will tell you to do, depending on what you see in the markets. Now, I'll tell you that from an overall perspective, I don't believe the tactical investing that way works. Now, having a manager, a specific portion of your portfolio that's tactical, there's nothing wrong with that, and you can get some gains out of that. You also take additional risks, right? BlackRock overweighted the EU last year, underweighted US, and it didn't work out well for them, as an example. All right. Prudential goes on to talk about the housing market, which really has been an interesting situation this year. So the housing market, as everyone knows, is completely taken off. And they write, the extremely favorable fundamentals of the housing market are inconsistent with the notion of a classic asset bubble. Asset bubbles occur when the price of an asset greatly exceeds its economic or intrinsic value. House prices are rising rapidly because of a fundamental shortfall in supply relative to demand. So unlike what we saw in the Great Recession, what we're really seeing here is that offset of supply versus demand. So at current levels of only 1 million, the number of existing homes for sale is at an all-time low and represents only 2 months supply at the current selling rate. So the average is 5.5 months. So if the average is a 5.5 month supply in the housing market, and now we only have a 2 month supply, well, as long as that continues, then prices will continue to go up. Once it balances back to that, well, now we have an average 5.5 months, then you're going to see a balance in housing prices. The U.S. labor market has been significantly affected by the pandemic, both in the short and long term. In the short term, there's been considerable shrinkage in the workforce. We've seen that, and we're seeing that on the availability of things. So people aren't able or not working or collecting unemployment, whatever they're doing. They're not creating things, right? So things aren't made as much or in as large quantity as they've been in the past, not available. I know that forget about the mail not ever showing up or showing up late. We send out these magazines, and many of you receive them that are just general information, and it's kind of a thank you to our clients. And we received 2 versions back to back in the same day. So I was standing at the mailbox. I'm sorry. So it would have been one day after another. I was collecting the mail. I stopped into the office a few days a week and I collect the mail, and I had it in my hand. I had 6 copies. We get 6 extra copies in my hand. The mailman shows up, the mail truck, and he puts 6 more copies in my mailbox. And I said to my wife, who handles this, when I got back, I said, what happened with this version of the magazine? So she checked into it, and they said they mailed them in February, but I guess they were just getting to us. So maybe you got 2 back to back, and that's kind of crazy. But that's one small example, because we don't have the labor force in the mail carriers that we did, and you can kind of just extrapolate that to many other things. So people aren't working. The labor force isn't there to create the things that we're looking for. Prices go up. Supply is low, demand is high. Same things that's happening in the labor market. Now, it's going to get worse as people get out there and they want to do more things. We're certainly seeing that in construction. Okay, and the manner in which work is performed has changed forever. Even the population, even after the population reaches herd immunity and the economy is fully reopened, many employers and employees will continue to work remotely. The work from anywhere employment model could persist for many years. So that we hired an employee who we're based in Bucks County, Pennsylvania. This employee sits, in her home, works from home outside of Orlando, Florida. Hi, Hamiko, if you're on this webinar. One of my employees said to me, Kent, do you mind if I travel down to see my family in Florida for the next 2 weeks? I'm going to be working every day, but I'm going to want to do it from Florida. Well, no problem. She can take her equipment and go anywhere. We all have Surface Pros that we use and plug into docking stations. So no reason we can't do that. Listen, I would like to, if I had my druthers right now, I'd be traveling around the country in an RV, having these meetings and these webinars remotely for sure, but I can't convince my family to do it. So things are going to change. We see it. There's an office building right adjacent to mine. Now, ours is much smaller, but this is a large complex office building, and I guess it has at least 4 floors. I don't know how many offices in there, but the parking lot used to be hundreds of cars in the middle of a workday, and I see 8 to 10 cars on a given time. I run over there this afternoon, for example, and I'll see 8 to 10 cars in that parking lot, and I don't see that changing, because what we're finding as employers and what we're finding as employees is that employers are finding, I know my staff is just as efficient, if not more efficient, working from home. Employees like the comfort. Now there's certain things about, getting up, getting dressed, getting out that people miss. And some people, they need to get out and get to the office, but you're going to see a major change in that. And I really don't know how long that's going to last. It's very interesting. There's been a massive widening in the gap of wage rates among workers. We're seeing that, unfold in our area here. So you all know that I sit on the Council Rock School Board of Directors. We cut our assumptions last year for revenues, tax revenues, but we came in actually much higher. We're in an affluent area. So what we're seeing across the country really is affluent workers weren't hurt that bad during the pandemic, or on an average basis. But lower income or middle income folks were really hurt bad. So we have to remember that as we're dealing with the effects of the pandemic, because while the affluent areas might have done okay, we don't want to bury the people who are already suffering in the wake of trying to get back to things. So transformation of the labor force resulting from these various trends should result in a notable increase in productivity. And they were talking about job training. I'm sorry, I missed that. But job training programs implemented by both the public and private sectors should help close this gap. It's just going to take time. Prudential pointed out that the biggest issue potentially with the markets is increasing inflation. So they believe that if we keep inflation at around 2%, then the markets could continue to roll the way they've been. Once we cross over to the 3 to 5% range, we have concerns and problems. So I think that's we're seeing that already. I think it's already here. I shared with you the consumer price index that comes out from the Department of Labor. Not the Department of Labor. Anyway, I can't remember who sends it out, but I get it monthly. I shared it with you a few months. That's going to bother me. I shared it with you a few weeks ago, but anybody can receive that information. And we went over the different inflation numbers, and they can really be surprising. So I believe that 3 to 5% is already here. We're seeing it in many, many areas, including fuel, including food, construction, supplies. Almost. Can you think of anything that's cheaper now than it was last year? I can't. Okay. So, again, how do we address these things? I've been asked, what changes do you make after you set up your portfolios when you see markets drop, changes in the economy, things like that? And my answer is we don't. We set up your portfolios with these fluctuations in mind. So you've heard me talk about strategic asset allocation, principal protection, and account segmentation. So my belief is that if you have these set up properly in your plan, then you can handle these whipsaws of markets, or, what are they doing in Washington? What's going to happen with inflation? Now, we're working on and going through right now changes in our portfolio. It's not that we just set it and forget it. We definitely make changes in our portfolio, but your plan and your investment strategy should be sound from the beginning. The components may change, and they will over time, but your strategy and your plan should be sound from the beginning, with very small changes needed along the way. And most of the changes come from you and not from what's going on in the crazy world around us. So I hope that makes sense. Let me pause there, see if I have any questions. No questions. Okay. So I'm going to share with you, we're going to talk about capital gains. And I'm going to share my whiteboard with you. So you're going to see here, the first thing, so raise your hand for me if you see my whiteboard in front of you. Thank you very much. And I'll make this a little larger in a moment, but this is the 2021 tax planning guide. This is from Ed Slott and Company. So I want to give them their credit. I refer to these all the time. Now, one of the updates we made on our website, I'm going to share with you, is that you can get these yourself. One of these, at one of these webinars, I asked if anybody wanted this and I sent it to you, but now we've uploaded it to our website. And you can go on and get these at any time. So if you go, here's our website, attleborowealth.com. And if you go to the slot corner, you're going to see, here's Ed and I, here's the benefits of working with an Ed Slott advisor. There's some other information in here. What is an elite IRA advisor? That's a really great video to watch. But down here, you'll see these tables. So we've got the tax planning table. We have the Medicare income planning table. We've got the retirement plan contribution limits. So this is something I refer to all the time because I don't know what it is, but these contribution limits, maybe because they change every year and as I say that, these have been the same for the past 2 years. I refer to this all the time as well. So contribution limits for plans, for individual IRAs, Roth IRAs, simple IRAs, that's helpful. Tax planning for investment income. This is something we're going to talk about right now. HSAs, health savings accounts. There's a chart for that, and the RMD chart. So single life table for inherited IRAs, and actually that's just shown. Let's see if hopefully that's, and you can download it. So let's download one, and hopefully you're getting both pages. Yes. So this is the one you want to focus on, is the uniform lifetime table. This is a dinosaur right now, isn't it? For most people, because the stretch IRAs are really done. But these are the RMD charts, uniform lifetime table that you want to use. And if you're 72, what this shows us is if you're 72, this is the factor you would use. So you divide your year-end value, the prior year, by 25.6, and that would give you the RMD, the required minimum distribution that you have to take. So you can access these on the website. We try to make it easy for you. Let me go back, and it'll be available. They'll all be available there. Now you may have to enter your email to get these downloaded, but that's okay. So I hope that's helpful. Now let's talk about capital gains. I'm going to make this just a little bit larger for you. Okay. All right. I'm going to be looking down as I draw on this, as I do. I just want to tell you where I'm going. And we're going to be focused primarily on this section here. Let me clear that. Oh, why did that get smaller all of a sudden? We're going to be looking at this section here. So these are capital gains. Now, I need to just change where my notes are. Give me a second so I can refer to them. Whoops, sorry. You see what's happening? I have 3 monitors here, and I'm looking at them all. So what's going on now with capital gains? Let's start with how things are now. And remember, we're working under the Tax Cuts and Jobs Act. That started in 2017, and it's set to sunset in 2025. Now, this isn't likely going to happen at this point. We're going to see changes before that, because we have Biden and President Biden and the Congress and the Senate seems to be in agreement that that's going to happen. So currently, let me just explain capital gain. So what's a capital gain? So a capital gain is when you buy, it doesn't have to be a stock. It could be a mutual fund. It could be an exchange trade fund. It could be a bond, but you buy a position. You buy, let's just say ABC stock at $100 a share. And let's just make it easy. So you buy just 1 share. So you've spent $100. Now, let's just say that 1 year later, so today is 4/27/2021. 1 year later, you've doubled your money. ABC has grown to $200 a share. And on 4/27/2022, you decide to sell it. So now we're going to make this, we're going to put a safety zone in that, and we're going to say 4/28 because that's 1 year and 1 day. Now, if you decide to sell that on 4/28, so this is your buy and this is your sell, then you would have a capital gain, a realized capital gain of how much? Well, the answer is $100. Whoops, $100 realized gain. This is important, realize, because you can have unrealized gain. That doesn't mean anything for us. So $100. So now currently, if you've owned this, now this is more than 1 year. So this is greater than one year. Your capital gains rate would then refer back to this table up here. So if your modified adjusted gross income, this is what we have to focus on, and that's how you figure out your a few things, what your IRMA calculation is, certainly what your capital gains rate is, but that's a modified adjusted gross income. So modified adjusted gross income came about because AGI, adjusted gross income, wasn't bad enough. They add back in some things to get your modified adjusted gross income. So you'll see that if you're married filing jointly and your modified adjusted gross income is below $80,800, well, your capital gains rate is 0. So you pay 0 tax on that, $200, and that's a great thing. Once you go over $80,801 to $501,000, your capital gains rate is 15%. And that's where most people pay capital gains. Pay attention to this. I'm going to make this larger. Pay attention to this asterisk, because that people forget about the asterisk. And the asterisk tells us that the 15% rate is effectively 18.8% for those subject to the 3.8 Medicare surtax on net investment income. Well, what does that mean? Well, they tell you right here. Though net investment income, the surtax applies to those with modified adjusted gross income over the thresholds of $250,000 for joint filers, right? So spouses, or $200,000 for single filers. So once you cross over that, you don't pay 15%, you pay 18.8%. And then once you go over 501,000, now these are married filing jointly numbers, 501,600, well, then you pay 20% plus the 3.8, right? So your effective rate is 23.8. Single filers, you'll see here that those numbers are essentially cut in half. That's what they do. Well, it's actually, you get a little bit more there, but the starting rate here is half of the 80,000. So 0 to 40,400, 0 tax. Anything over 40,401 to 445,850 is 15%, and anything over 445,850 is 20%. And if you trigger this surcharge, then you have to pay that extra 3.8%. So let me pause there, see if we have any questions. That is long-term capital gains. Okay, I see no questions. So let me erase that for us. So this is going to take a moment because I made a mess all over this here. Okay. Now back to our example down here. So then we know if so this $100 growth could be anywhere from 0, 15, or 20% under the current law, with the potential 3.8%. That's from where that 3.8% come from, by the way. That came from the Affordable Care Act. So that was the Affordable Care Act surcharge that was added in with the Affordable Care Act legislation. So it could be, depending on your modified adjusted gross income, you're at 0, 15, or 20%. Plus here, the 15 to 20, you could be subject to the 3.8. Now that's if you're greater than 1 year. What if it's less than 1 year? Less than 1 year. This is simple. So if you decide to sell this, if you say, wait a minute, I'm going to sell this. I made $100 a share, and I'm going to sell this on 4/1/2002 instead. Well, then that becomes a short-term capital gain. And short-term capital gains, well, how are they taxed? Well, they are taxed right here. So just like ordinary income. So if your short-term capital gains falls into if your taxable rate falls into 22%, and you pay 22% on your short-term capital gains. So that one's easy. All right, and I don't see any questions from there. So what is proposed? Well, let me pull my notes back up here. Well, the first thing that's proposed here is you'll see that our top marginal rate over here is 37%. What was it prior to the Tax Cuts and Jobs Act? Well, it was 39.6. So the first proposal is 39.6. Take that back. And that's for anybody over $400,000 in taxable income. So right now you'll see that you don't reach that until $628,000, but under the proposed Biden plan, that becomes $400,000. There's probably going to be some big shifts in these brackets too, but right now the big talk is 39.6 for 400,000. Now, how about capital gains? Well, capital gains, that you remember the discussion over here. What they're saying is they're going to increase the top capital gains rate to 40% for anyone making more than $1 million a year. And that, of course, with the surcharge, will take it to 43.4%. I'm sorry, 39. It would be 39.6 also, 39.6 for anyone making over 1 million. And that would take it with the surcharge, because you would hit the surcharge at 43.4. So I hope that makes sense. That's for long-term capital gains. So it could be argued that, well, you might be better off if you're below this area, depending on where you're coming in, selling things at short-term capital gains, having it roll into your earned income. But that's yet to be seen as far as a planning perspective. So it may be that we have a lot of people selling embedded gains or unrealized gains in the next several months. And then it becomes just selling on a regular basis, because I was talking about realized. So if you don't decide to sell this, if you're, let me give us some room. If your ABC stock starts at $100 a share and grows to $200 a share, and you keep it, what's your capital gains rate? No, it doesn't. It's nothing right now, because it just stays in there, right? That's called an unrealized gain. Now, that's if you own the stock. One of the reasons people say mutual funds are tax inefficient is because your mutual fund could own A, B, and C stock, and they could decide to sell it. So they bought it at $100 a share. They sell it intra-year at $200 a share, even at whether they wait a year or they don't wait a year. And they pass those capital gains on to you. And you have no control over that, with no control. And in fact, what can happen is mutual funds can have realized gains. So you might get a bill for several $1,000s in capital gains, but the mutual fund might be down at the end of the year. And that's always an uncomfortable situation. We were worried about that actually this past year, because nobody thought this time last year that we would have capital gains for 2020, but we certainly did. So I hope that's helpful. I wanted to shed some light on what these the beginnings of these tax laws look like. There's a lot more involved in the proposed tax changes. You know, corporate taxes. There's a lot more for individual taxes, but these are the two big ones that are being talked about right now, especially capital gains, because people are concerned that it's going to affect the market. It's going to affect the stock markets, because people are going to be suddenly selling, and that may happen. So certainly, if people have an opportunity to get out at 0%, they may take advantage of that. But if you're looking at a 15% or a 20% compared to 39.6, it could certainly you could certainly see a lot of folks selling out of their positions. Now, you might say, well, that's only for people making $1 million a year or more. In my experience, that's likely to come down. And it's also likely to have a cascading effect. So I would be surprised if it just applies to people who make $1 million a year, and it may start there, but not end there. So I hope that's helpful. It is 10:40. We've covered some market updates, some planning updates around capital gains. We've gone over some analyst reports. So I hope all that was beneficial. We have our upcoming webinar, special webinar series that you'll get invited to. And when you log off of this webinar today, you'll have an opportunity to schedule time with me if you'd like to. If you haven't already had a no obligation, no cost consultation. As I always say, if you're a client of ours and you want to schedule time, if you're not already scheduled, feel free to, you have access to my calendar all the time anyway. But this calendar that comes up for the webinars is a little different. If you already have a financial planning appointment scheduled, we need time to prepare for that. So don't schedule something tomorrow because we won't be ready for you. There is a question. Let's see who's asking a question. Let's see. Kathy, is the Medicare surtax calculated for each year? Or are you subject to it going forward once you hit that mark? It's calculated each year. It's different than IRMA. You might be thinking of IRMA. And Laxman asked, these are changes at the federal level. What about state and local level? Well, every state's going to have their different tax law changes. So we have some increases scheduled here in Pennsylvania. We don't know what's going to happen with that, but you're going to be subject to whatever's happening in your state. Locals, another issue. You have to be concerned about state and local, of course, in addition to federal. Listen, local municipalities are really pressed. I know that we have a scheduled 3% tax increase here in our school district. I think next year it's projected to be around 3.1, 3.5. And it drops off a little bit after that, but municipalities are in bad shape. They're trying to get all the revenue that they can. School districts, local municipalities, and states. Everybody has this pension problem. We've talked about it before. We have these unfunded liabilities with these pensions. Ours goes up every year. It was about $5 million almost 8 years ago when I first became on the board, and now it's I think $37 million that we have to contribute. So these things are really hard to get our arms around. So yeah, everything's going to go up from a tax point of view. What I mean, capital gains included in federal, state, and local taxes. Federal taxes is where depending on where you live. The changes I'm referring to are the federal taxes. So if you want to talk offline, I'm happy to have that discussion. You can schedule time with me, and I'll learn a little bit more about where you are and get you the information you need. All right, folks, have a great day. Have a great week. We'll see you here next Tuesday. If you have any questions, reach out and we'll talk to you soon. Thank you. Have a great day. Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.